Hey there, Hiram here with Ladder Financial Group. Today I want to bring a really interesting topic here for you guys that a lot of business owners I think need to know. If you're maybe in the startup phase or possibly in business already generating revenue, obviously we know that a lot of times we have to take on debt that we don't want to, but unfortunately a lot of the lenders are not available to you where you can produce a whole full 2 years of making 20 grand a month or 40 grand a month. But interesting topic today that I want to cover is called transfer of liability debt, right? It's just different than what we call an asset balance transfer, and that'll be another video that we'll make. But it's simply a transfer of liability, that debt that you've accumulated in your personal name in order for you to start this business or in order for you to continue to grow and scale your business, right? So let's talk about credit really quick, right? Utilization. When it comes down to $100,000 debt that is all in your personal name, okay? Utilization is super important, right? Utilization is super important. It makes up 30% of your personal credit. That means that when you first started the business, you worked really hard in maintaining that great payment history, behavior, on-time payments, and you kept those utilizations down. But as your business requires more utilization or more usage or more debt to obtain, then obviously we know what happens is that credit from a 700 starts to tank, and then eventually you find yourself down here in more of the high risk lenders that will give you a loan with that credit, but obviously just like a car loan, just like a mortgage, just like anything you purchase under consumer credit, you're going to get hit hard with interest rates, right? So we don't want that. So the most important thing is, okay, if you've already done the mistake on taking on debt with your personal credit, there's still ways to work around it, right? There's still ways to transfer that liability, that debt, to the business. Now, the greatest thing about doing this, right? Hear me out. The greatest thing about doing this is that you can establish a credit profile under the business EIN, just like you do with your Experian, Equifax, and TransUnion, right? They're called your Dun & Bradstreet, right? Your Equifax, right? And your Experian. And now the new one that's coming out that a lot of people are focusing on, or a lot of banks are focusing on, is FICO SBSS, right? Excuse my writing. FICO SBSS, which a lot of the SBA loans, a lot of these big lenders that we know are using that internal scoring system that also checks your personal credit and your business, right? So we know that the best credit score for business, that you've done a Bradstreet's got to be over 80. Your Experian, your Equifax got to be over that 85, 90 in order for you to look like that 750, 800 credit score, but through your business. But let's talk about utilization, right? Again, utilization makes up 30% of your personal credit. With a 750 credit score, the more you continue putting that utilization, putting on that weight under the business, that means trouble, right? You're considered a high risk to a lender, and anytime that you're considered high risk, you're actually closing a lot of doors and a lot of opportunities with other lending institutions, right? The second thing is inquiries, right? If they see that you apply for Amex, you apply for Chrysler for a business fleet loan for your company. You apply for another bank, BOA, Bank of America, and all those inquiries. But the thing is that the banks don't see these accounts active on your credit. So what they're saying is that you're shopping. So that increases your risk even higher. So the problem is, when they see these accounts and these inquiries that are on your inquiry board, and they don't see these accounts active, then they know you're shopping, and guess what? It's gonna be very hard to be able to get that credit that you're trying to apply for. The third thing is payment history, right? There are some times as a business owner that we have to, borrow from Peter, pay Paul, right? Like they say, and a lot of times we're shuffling money around, even pulling money out of our W-2 job, right, to provide the right money for the business in order to pay for marketing, in order to pay for expenses, in order to pay for brick and mortar location. But payment history sometimes is very important. A lot of banks are looking for a 24-month payment history. At any given moment, they're looking for a 24-month payment history. So if you screwed up on one payment, they're immediately considering you high risk. You cannot handle debt under personal debt. So what that ends up happening is, why would they loan you business credit? Why would they loan you business loans? Why would they provide you any types of lines of credit if you miss a payment within that 24-month period? Okay. The other thing is behavior. Banks love behavior, right? And what that means is that if you learn the strategy on when your payment date is and when your reporting date is, there's two different things. You always have to call your company and say, okay, when is my payment day? You know that it's on the 9th of every month, but when do you report is the important question. You want to make sure that that window of opportunity that you have, you are on it as best as possible. There's a lot of people that have learned this little secret, this little code in the whole credit world, and they know that the payment date and the reporting date is different. So that means if there's a 10-day window, payment date's on the 9th, reporting date's on the 19th, in that window, you want to keep that possibly zero balance, right? So you got to borrow money, shuffle, and make sure that that payment history is always on time within that 24-month period, okay? Back to inquiries. Banks don't like to see no more than 6 inquiries within a 6 to 9 month period. So write that down. That is super important. You want to make sure that if you do have heavy inquiries, that you want to start talking with maybe a company like us or a credit restoration company that you know that can remove those inquiries for you, okay? So let's do a quick comparison, right? A personal business debt versus a business debt, right? This means that this is an extension of your personal credit. So that means that you're always putting your social security on the line in order to obtain the credit and reduce that liability to the banks, which banks love, right? They love. And then business debt, that means that it's going to go strictly under the business EIN. So when they say, hey, we're going to need for you to pull your credit, you're going to say, no, not at all. Why would I? Okay, it's going to be strictly under my business EIN. You're actually going to transfer you over to a business department where they'll be able to transfer, or they'll be able to have you fill the application strictly under the business EIN. So let's look at this. When it comes down to business, right, or personal, you need to be able to, you're going to get low approval limits, right? So let's take, for example, let's take a Visa, let's take a MasterCard, and let's take Amex, right? Because you don't use your cleaning company, you don't use cleaning supplies in your personal life like you would with business. Those accounts are basically going to say, okay, we'll maybe give you a $3,000 limit. Another bank will maybe give you a $5,000 limit, right? And then maybe another lender will give you $10,000 limit. That's cool, right? What do we got? 18 grand here. But when it comes down to business, you get 50 to 70% higher limits than you would business. That's why we're able to do with one of our programs, get you up to $200,000 strictly under your business EIN, okay? The other thing here is that inquiries matter when it comes down to your personal. We spoke about that. When it comes down to a business, there's no factor rating. There's no factor rating. When it comes down to on the inquiries, it's irrelevant because business can apply for as many things that they need and they want, and that will not decline your score per se, right? The other thing here is you're always going to get shorter promotional rates when it comes down to personal, right? Because there's more people applying for personal. Not everybody's a business owner, right? Obviously, small business is the backbone of America, but not everybody owns a business. So that means that there's going to be a higher supply or a higher demand for personal accounts than there would be for business, okay? So what that means is that the promotional rates, let's say you get a 0% promotional rate for about 9 to 12 months. We've all experienced this, right? Synchrony Bank, you buy a motorcycle, a lot of times they're gonna send you to Synchrony Bank and they'll give you a promotion on 0% on a $15,000 limit, right? But let's take a vehicle that you're gonna purchase either with Ford Motor Credit Corporation, or you're probably here, or this other company, or even if you need to obtain some sort of Amex, right? You're usually looking at a minimum of 12 months, all the way up to 24 months promotional period. That is strong. Imagine you getting approved for a $200,000 loan, that you have a very small payment, that you can make the minimum payment and have 0% financing for 12 to 24 months. Think about that. That is huge, right? And this is what we definitely want to teach you. This is the strategy that you need to have in place in order for you to really conduct this business, make this business scalable, and create this tremendous empire out of that small dream and that small vision that you once had. Keep going, keep that fire going. All right, Ladder Financial, Hiram here checking out. I thank you so much for checking us out, and we'll talk soon. Bye for now.